You're tuned in to Agriculture Today, and we start our Friday show with a grain market update from K-State grain economist Dan O'Brien. Dan, thanks for joining us today.
Thank you, Shelby.
Dan, as we look at the grain markets, what are we seeing after last week's WASDE report?
Well, not lots of strength. That report actually had some information that the market, if it was focused on the usage side and the ending stock side of things, uh, actually, especially in corn, could be responded to quite positively, and we'll talk about more about that later. But I think the primary focus of the market continues to be on crop production issues. The crop ratings for the U.S. corn market, U.S. corn overall, are uh, again graphically, if we were looking at it, whereas normally we have a seasonal downtrend right now, the national crop ratings of percent good and excellent shooting to the high side still. So I don't doubt that probably is the main factor in play. Again, no major crop risks uh, on the horizon, although you can see from the information on the weather forecast, 6 to 10 day forecast that we see graphically. I think Chip Redmond as talking about at different times here of late that yeah, there's some hot dry weather coming in, but again, no major big issues that are driving things. What I have heard climatologists talk about is that we're generally looking at the condition for U.S. corn and soybeans right now as generally good overall, but there's a lot of pockets and that are involved in that. So, and one or two crop threats that in terms of crop development that I hear being discussed, but again, none of them front and center yet to change the overall narrative that prices are but that grain prices are moving to the low side, or nothing to interrupt that train of thought yet, as we look over the next several months heading off into fall. I would say specifically for corn, we've seen the September contract close down to, well, yesterday closed at $4.02. Again, that's you're hanging around four, going below that sometimes. The December contract at 421. It's interesting that the December 25 contract, 421 per bushel, $4.21, and the December 26 contract that the D's futures for the end of this calendar year for the next crop. End of this calendar year, going off into next year, literally $4.56. So where does the market tend to go on futures when it here of late when it doesn't really know what's going on in terms of planted acres or whatever? Oh, around 450. So we're that kind of reveals where we're at right now in our thinking. If kind of a normal crop situation is about $4.50, $4.60, well, right now we're at about 420. So really showing the ideas of the market as we stand today. November soybeans, $10 and 26.5 cents. It's interesting that heading off into next summer, you get summer of 26. Year from now, the you're looking at August 26 futures at $10.76, 10.77 cents. This year's futures is about $10.21. So again, similarly, futures really showing a leaning, a bias, a narrative towards large crops and lower prices, at least in their view. And of course, with wheat, we're looking at Kansas City hard red winter wheat, Kansas City hard red winter wheat futures. I say Kansas City because we used to trade there in Kansas City. It's still Kansas hard red winter wheat, but now it's traded with CME, of course. But anyway, closed yesterday at $5.17.5. Been volatile, moving with some up and down movement here of late in that market. But harvest pressures, et cetera, all in play. There is some information, particularly for hard red, that came out of the most recent set of USDA reports that we'll talk about. That WASDE report on last Friday on the 11th that has was showing strong prospects for U.S. hard red winter wheat exports. So we'll talk about that. But so far we're harvesting grain right now. Probably the biggest story price wise in the futures for wheat are the carries. Again, you've got we seem to be set up for a situation where we will bring in a large harvest. A fair amount of that. If it's sold immediately, it go into elevators. Elevators are looking at carries right now from the September to the Dees contract of about 7.5 cents per bushel per month. From Dees to March, just a little over 7, just under 7, heading out to May. So it's setting up really more for a storage situation, unless these exports for hard red winter wheat continue to, pardon me, to operate in a very strong manner in the coming weeks and months. So I guess we'll have some competition between storage and maybe export sales, and that'd be welcome for the for hard red winter wheat growers that perhaps don't sell right now and are looking to store the crop and see what might happen in coming months.
And as you were talking about this, anything jumping out for cash prices?
Yes, I think uh, it's well, the hard red winter wheat harvest first and foremost stands out. You see the highest prices in the state, and these are the top elevator bids in these regions. There are other elevators nearby that aren't as high as this, but the top bids were in the Hutchinson area, $5.26, Salina area, $5.24, and that's the current cash price. So last half of futures thereabouts. Other prices much lower. Topeka at 497, but then you go out in Western Kansas at Colby at 448, Garden City at 438, Pittsburgh down southeast at 455. So generally low there, and I would say also cash corn prices, top prices in the state. At least that I saw, 407 in the Garden City area, 417 actually in Pittsburgh. One bid up at 417. Almost all the other bids below $4, but one flagship bid out there, and just not a lot of worry about what may happen. Again, if we were worried about Kansas corn crop prospects, we'd see different cash price situation, I think. But since we're not at the moment, then we find ourselves with prices in most places below at or below $4.
And last week we talked about pre-report expectations for the WASDE report that was coming out July 11th. And as we're talking about it now, as the report has come out, anything sticking out for feed grains?
Well, the USDA supply demand balance sheets were adjusted some for corn and for grain sorghum, mainly for corn, and the following from the lower planted acres that we saw at the end of June, as well as that stocks report that showed some changes in usage. You did see for the old crop contract that the USDA scaled back its feed usage numbers by about 75 million. Still 5.675 million, and made some other adjustments. Exports raised 100 million bushels, up to 2.75 billion, record high, tremendous exports. Then following that, here you can see it this week at what we had in the most recent week for July the 10th. Even that number might be slowing down just a little bit, that pace. But it's pretty obvious to me anyway. When you look at what the USDA had done, they looked at the commitments out into the future. Again, for the next 6-7 weeks in the marketing year, saw what countries have said they're going to buy, and that's basically what that number is, 2.75 billion. So put all that together, and we ended up and dropped old crop ending stocks down to levels, as you and I've talked about on these programs in the past, where in the past when we've got down to 1.3 billion bushels, we've had $5.50, $6 corn, but not this year. Again, it's the anticipation of that big crop coming, I think, that's keeping the lid on it, keeping a pretty pessimistic view of things. So we're down to 1.34 billion bushels for the marketing year, projected for the marketing year that'll end on August 31st. And of course, you bring lower beginning stocks into that into the equation, and the USDA did adjust acres down a little bit, and so instead of projecting 15.8 billion bushels, now 15.7, and ran that through the balance sheet, made some other adjustments, a little lower feed usage, Ethanol unchanged, a little bit. Uh, Right, that's right. By the time we bring all that through, the main changes were the lower beginning stocks and lower production figures, a little bit lower on feed use, and now we're projecting 1.66 billion for that next market year. So again, we ag economists we hang out in the numbers. We look at some ending stocks to use. 1.6 billion bushels is not that much, especially when you figure, gosh, a 15.6 billion bushel corn crop when we've only had 15, one or two in the ever before. So the key to that balance sheet is strong usage, even with large supplies, and so we'll see where it all goes. So we on the bearish side of interpreting the corn supply demand balance sheet that the WASDE report came out with, basically they're anticipating by far record high corn production. And that is the focus right now of the market. They're also projecting those pretty strong usage that if we actually have 1.6 billion bushels or 1.5 when we get to December, then we'll look around and say, this is kind of tight in terms of supplies. But right now, again, we're focused on the production side, and we'll see where we're at. There was a change in the couple changes in the grain sorghum supply demand balance sheet. Production based on lower acres, basically down about 25 million, and the export figure projected for the next marketing year down about 25 million. So still very conservative in terms of grain sorghum prices projected for both this old crop marketing year at $4.10, new crop $4. So feed grains, pretty, I guess we'll be polite and say subdued with given what the market's focusing on right now. The underlying issue though is, gosh, lots of usage, pretty pretty tight stocks, and we'll see where that takes us at any hint of crop risk or geopolitical issues that affect the feed grain market off in coming months.
That was K-State grain economist Dan O'Brien. We're cutting to a short break now on Agriculture Today, but when we come back, we'll once again be joined by Dan as we continue our grain market conversation.